Thank you, IDB, for the kind invitation. So my job today, I guess, is to give you just like very big picture where we are in the global economy, the challenges, the transmission channels from the Trump administration's policies on Latin America, how we're thinking about our economic, political, fiscal outlook, and I'll just briefly end with what we are seeing in terms of rating trends in Latin America. So let's start. Obviously, a lot to cover here. But I think the first thing is just setting the stage from the global economy perspective. What are we seeing? What are the biggest risks? And I think the biggest risk for 2025 really was the risk around the tariff landscape. That's been shifting, moving throughout the year. We've had three distinct types of, let's say, tariffs, starting with the fentanyl tariff that was imposed on Mexico, Canada, and China. Then we moved on to the reciprocal tariffs, which were obviously much more, prevalent, for many countries around the world. And then you had the sectoral tariffs as well, coming on steel, aluminum, autos, for example. We've also seen very much multiple phases of tariffs, over this year. Obviously, we started with the shock and awe of the Liberation Day. Then we saw escalation with China. Then we saw de-escalation with China. Then we started seeing some bilateral agreements being agreed upon around August. Then we started to see escalations which were ad hoc in nature with Brazil and India. And now we seem to be again getting to a little bit of a de-escalation mode, given what we saw last week in Asia with a temporary truce with China for 1 year, a number of trade frameworks being applied in Asia as well. So the question now is, where are we in terms of the effective tariff rates in the United States? How much more protectionism are we going to get in the US? I think the first thing is on this chart is, if you think about where we were in effective tariff rates last year, we were about 2.3% or so less than 2.5%. That number at the peak of the escalation went up to 30%. Huge, dramatic increase. Now we think, I think in August when we ran the numbers, we were thinking that the effective tariff rates in the US would be about 16%, so that's the blue line. But now, after some of the trade deals that have been announced last week, we think we are somewhere around 14% at this time. So again, a pretty significant increase in trade protectionism. Now, the other question to ask is, what should we be looking forward to? What are the risks ahead? I think there are a couple that we should be thinking about. One is, what is the Supreme Court going to say in terms of the legal underpinnings of the IEEPA-related tariffs that have been imposed by the Trump administration? We continue to believe that trade protectionism in the US is likely to be sustained. Even if the Supreme Court was to overrule the IEEPA tariffs, we do think that the Trump administration is going to use other tools at its disposal to impose tariffs. And then the second thing is whether we will see de-escalation between Brazil and the US or India and the US. And the third is really if you're going to see more sectoral tariffs that are going to come our way. So that's where we are in terms of the tariff picture. What does that mean for the global economy? What does that mean for the US and China, the largest economies in the world, but also very important trading partners for Latin America? So our view on the US economy is that the US economy is slowing this year. We have a growth rate of 1.6% this year for the US, a pretty significant slowdown from almost 3% growth that we saw in the US last year. Again, that's a reflection of cooling off of labor markets, but also a reflection of this increased business and uncertainty that we've seen in the US, partly because of the tariff picture that has been shaking out this year. The other thing I would say that even though growth is slowing, We were never in the recession camp in the US. I think in that sense, the US economy has continued to be largely resilient. And I think there are a couple of reasons for that. There was a lot of momentum coming into 2026. The labor markets were holding up in the first half of this year. We still have a very expansionary fiscal policy in the US. And you've all heard about the AI campus boom that's going on in the US. And I think that is providing some support to the economy. We expect growth to be somewhere around 1.6% also going into next year. The One Big Beautiful Bill has additional tax cuts which will be helpful for the US economy going into next year. We also are expecting Fed rate cuts going into next year. So all in all, we do think that the economy is going to chug along, but at a lower growth and a lower than potential growth going into next year. China has been economically resilient. We have seen China going close to 5% this year. That's our estimate for this year. So it's pretty much in line with what the Chinese authorities set themselves out in terms of their targets for this year. Now that said, I think the export resilience that we've seen, I think that's what we are going to be looking at. We've seen a lot of export resilience coming out of China despite this tariff storm. Part of that is just front loading that we saw. And the other part is a bit of a successful trade diversion that we've seen out of China, where we've seen that Chinese exports coming to the US have dropped, but these have been more than offset by increases in exports going to the European Union as well as other Asian countries. Now that said, we do expect Chinese economy to finally begin to slow down a little bit more materially going into next year. Our current forecasts are that Chinese economy grows around 4.1% next year, and that's really the picture around domestic demand, which we think is still struggling. Part of the reason is the consumption part, because the consumer sentiment remains weak because of the property market, which I'll talk about in a minute. The job conditions are not that great, so that is sapping or weighing on the consumer sentiment in China. But the second thing, and the more important thing, is the property market. I think the second chart there shows you on a couple of measures, the property market in China still has not stabilized at this point in time. We expect continuing contraction in the property market going into next year, and that will also weigh on domestic demand. Now, in terms of the inflation and US Fed rate cuts, we do expect inflation in the US to come up a little bit going into, in the next few months, as we think that some impact from tariffs should begin to show up. In terms of rates, we don't think any further rate cuts in the US Fed in December. So we think that the Fed's done for this year, but we do continue to see rate cuts going into next year and into 2027. We expect 75 basis point cut by the US Fed into next year and a terminal rate of about 3% in 2027. So moving on to what does this mean for Latin America? What are the transmission channels? I think on the trade front, if you took out Mexico, the rest of the region is going to have a pretty moderate impact from our perspective. If you look at the middle chart, you can see that not many countries in Latin America are really running trade surpluses, which has been a very much singular focus of the Trump administration. Obviously, Mexico is running a significant trade surplus, but that is not the case for the rest of the region. Also, the impact, if you look at the last graph, you're seeing exports to GDP or exports to the US as a percent of GDP. That's only high in the case of Mexico. It's not really that high for the rest of the region. Now, in terms of tariff rates, I think Latin America has come out of this round of, tariff storm, relatively well. If you take out Brazil, which obviously faced about a 50% tariff rate, the rest of the region has come out more or less around 10%, which is relatively good position. It's in line with what the UK got, and it's much better than some of the other countries in Asia, which have gotten a tariff rate between 15 and 20%. So in that sense, we think if you exclude Mexico, the rest of the region is not as exposed to the tariff storm. And even in the case of Mexico, I mean, I think the things that we have to wait for is to really think about the USMCA review that's coming up next year, the 25% tariffs that have been imposed, that were really imposed on Mexico's non-compliant US or non-USMCA compliant exports. Those exports, goods are becoming more compliant, so we really don't see a significant, increase in tariff. We think that effective tariff rate in Mexico is going to be around 5% or so. Now, thinking about the other channel of transmission from the Trump administration, that's obviously more restrictive immigration policies. You've seen on the left graph, you can already see that the border crossings have come down quite materially. Remittances are very important for a number of countries, but particularly in Central America, where the range is between 15 to 25% of GDP, somewhat much more moderate in the case of Mexico. And what you are seeing so far, in the last chart, year-to-date remittances, especially going into Central America, have proven to be quite resilient. Now, that could be the front-loading story again, as we've seen in exports in some of the countries in Asia, might be applying to remittances story as well in the case of Central America. So this is something that we're going to keep an eye on. As you all know, the One Big Beautiful Bill did have additional security and border security funding, and that could mean an increase in deportations going into next year. So we're going to keep an eye on the remittances performance, because that's essential for supporting consumption in some of these Central American countries. Now, more broadly, how are we looking at Latin America's economic growth prospects? I mean, I thought the first thing is to look at it from a comparative perspective. The first chart shows you Latin American regional growth still is a bit of a laggard compared to the other emerging market regions around the world. This, we think, is much more structural in nature. This responds to the low savings and investment rates. In fact, investment rates in the last chart, you can see a number of countries, we've seen a downshift in investment rate in recent years. That might be explaining some of the deterioration that we might be seeing in trend growth in the region as well. Besides the low saving rates and investment rates, there's obviously issues around business environment in terms of infrastructure lags that we see in Latin America, in terms of creeping state interventionism that we've seen, unraveling of structural reforms in some countries, governance challenges, and political issues that also dampen the animal spirits in domestic economies. So these are some of the structural reasons why we see growth rate in Latin America to be much more moderate compared to the other emerging markets. Now, in terms of growth performance in 2025, we expect median growth in Latin America to be about 2.7% or so this year, slightly lower than 3.1%. That's a pretty good, performance, especially against the backdrop that we are, especially on the global scale. It's also better than the average that we saw in 2015 through 2019, which was roughly around 2%. But what I would say, that median only gives you a bit of a picture. It just gives you a snapshot. Look at the dispersion, the heterogeneity in terms of growth rates. Mexico, in the middle chart, the weakest growing economy in 2025. A lot to do with external uncertainties and the tariff storm and the uncertainty around that. And you also see the bigger countries, somewhere between 2 to 3% ranges where we are seeing growth rates. The fastest growing economy being Paraguay at this point in time. And as we look into 2026, we expect the Mexican economy to grow a little bit faster due to some reduced uncertainty related to tariffs, but we do expect Brazil to slow down because of its tight monetary policy, obviously an election cycle coming in Brazil next year as well. Just quickly on the other macro themes, inflation after the shock seen in 2022 globally because of the war in Ukraine, we have started to see disinflation over the last year and a half. clearly, at a different pace in different countries, but disinflation has been proceeding. It is becoming tougher for lots of countries right now to hit their targets, at this point in time. The last mile is always difficult on disinflation, but the good news is that we are seeing disinflation. And we're also seeing a number of central banks in the middle chart, you can see, have been cutting rates, with the exception of Brazil, which had to, going into this year, has been increasing interest rates. It's been on an extended pause. But we are seeing multiple countries now pausing the monetary easing cycle, much more data dependent, and to see how their monetary policies will help in reducing inflation and keeping the inflation expectations anchored. Real rates, are high in Brazil, as you can see from the last chart, but more or less for the other countries are now in line with what we're seeing in other emerging markets as well. Now, looking at external accounts, I think external accounts have been pretty resilient in Latin America, given the external backdrop. Current account deficits, as you can see in the first chart, median current account deficits still pretty low, below 2% of GDP. Some of the countries that used to run higher current account deficits a few years ago, like Colombia, also seeing current account deficits going below 3% of GDP. Mexico, current account deficit below 1% of GDP. The only country where we're seeing, a higher current account deficit at this point in time has been Paraguay, but it's also been the most resilient and the faster growing economy. International reserves, external ammunition to fight or to weather the global shocks that we are seeing are decently good. Most countries with more than 3 months of coverage in terms of international, in terms of imports. The only countries that have it below 3 months are generally dollarized, like Ecuador, Panama, or are already rated very low, like Bolivia at this point in time. The other thing that I would say is that a lot of countries, especially the bigger and the larger countries like Mexico and Brazil, the foreign currency exposure of their government debt is very low, the last charts. And that means that even if there is an FX depreciation, it does not really spill in that much into their debt dynamics. That's not the case for a number of countries. Obviously, the last chart shows there are a lot of countries with over 50% of their debt in foreign currency, but the larger countries have done a better job. And at this point in time, the dollar weakness also is helping countries contain the deterioration in their debt dynamics. Now, moving on the fiscal side, there's always been a challenge for the region, but there is some good news. I think if you look at the first chart, what you do see that Latin America's median fiscal deficit has actually come down compared to the pre-pandemic level, whereas that's not been the case for rest of the emerging market universe, where the fiscal deficits are still larger than they were in the pre-pandemic period, despite the fact that these regions have been growing faster. So there has been some element of fiscal consolidation, some element of fiscal discipline that we've seen in Latin America. The not so good news is that a number of countries in Latin America are still saddled with high fiscal deficits. We're talking about clearly countries like Brazil, as you can see in the second chart, also countries like Colombia that are also running reasonably high fiscal deficits. Even Mexico and Panama are running moderately high fiscal deficits. And as we look ahead in terms of fiscal consolidation challenges, we see a number of them. First of all, we think that Latin America's growth is going to remain moderate. We are not expecting a resurgence in commodity prices. We are still seeing spending pressures in the region. Interest payments, the last chart here shows that the interest payments have been going up in across the region. So that's been a pinch point. Social spending has been a pinch point for a number of sovereigns. We are not really seeing major tax reforms in the region. Yes, some countries are attempting tax administration and taking some measures to improve compliance, but that's very difficult a priori to know how much that's going to yield in terms of revenues. And then you've got countries like Mexico that also have to provide funding and support to their national oil company, which is Pemex. So a whole score of, let's say, challenges ahead for fiscal consolidation going forward. And another thing that we are seeing in the region is the diverging debt path. I think in the left side, you've got the bigger countries like Brazil, like Mexico, like Colombia, where debt to GDP is continuing to rise. So primary balances are not sufficient for debt stabilization in these countries. The picture is very different on the countries that you see on the right side, where debt, yes, in some cases was high, but is falling. And these are countries in the Caribbean, in Central America, where we've actually seen not only the economic recovery take hold, but countries actually much more, let's say, focused on fiscal consolidation. They're institutionalizing their fiscal policy, developing fiscal frameworks that will anchor and guide policymakers for fiscal consolidation, which is helping with the debt decline. Also talking a little bit about the political challenges in the region, I think the first chart shows you where Latin America scores relative to the other emerging market universe in terms of governance indicators, which are published by the World Bank. And what you can see is the shortcomings in Latin America in things like government effectiveness, in terms of rule of law, in terms of control of corruption. And while I don't have a chart here, I would also say if I took a 10-year look at what the trends have been in Latin America, what you do see in most of the countries, and especially the larger countries, there has actually been a deterioration in percentile terms in terms of their governance indicators. Now, in terms of the election landscape, which is the last table, I mean, obviously we've seen some elections already this year. Argentina, being one of the most important elections for this year in terms of, it was obviously a midterm congressional election. President Milei's party has done well. We will obviously, keep an eye on what does this mean in terms of governability. What does this mean in terms of continuing with the reform momentum? What does this mean for Argentina to begin to rebuild and increase its international reserves, which really is, still remains the Achilles heel of the Argentine credit profile. As we head into 2026, a number of elections are going to be coming our way next year. Most important of them are clearly Brazil, Colombia, and Peru, for example. In the case of Colombia and Brazil, both countries running high level of fiscal deficits that we just talked about. So we will be focused on seeing how the next administration plan to address the fiscal challenges in these two countries. In the case of Peru, we'll be focused on seeing what does the political landscape look like, given that we've seen recent impeachment of the ex-president Velarde, whether we are going to see continuing governability and governance problems in Peru, or we will see a milder form of that and a better political landscape, which actually helps in promoting confidence and promoting mining investment and promoting reforms and growth in Peru. So with that, I would just end up with talking about how the ratings have done in Latin America in this external environment. First thing I would say is the rating positioning. What we are seeing in Latin America is a shrinking base of investment grade sovereigns. We've got 5 sovereigns right now in investment grade. Chile at the highest at A-, stable outlook. Mexico at the bottom at BBB- at stable outlook. We're also have seen Colombia, Panama, and Brazil lose investment grade in recent years. Brazil lost it in 2015, 2016, and Colombia lost it during the pandemic, and Panama lost it last year. Now, the bottom of the scale, we've got 3 countries in CCC category, which are, which generally are for countries that are either, where we think financial distress is pretty high, where default is a possibility, and here you've got countries like Bolivia, Argentina, and Ecuador. Now, in terms of how the ratings have evolved this year, despite the tariff storm, despite the global uncertainty, despite the global slowdown, despite the commodity prices softening in some cases, Latin American sovereign ratings have really held up and actually have done relatively well. We've done 4 upgrades this year, including Argentina and as well as Guatemala, which was our most recent upgrade in the last couple of weeks, and we've only done 1 downgrade, which is of Bolivia. If you look at the outlook picture, which actually tells you in which direction the rating could move in the next 2 years, it gives you a directionality of ratings. what we are seeing there as well is that positive outlooks are far outweighing negative outlooks. In fact, almost 1/3 of the portfolio seems to be on positive outlook. Again, note the positive outlooks are mainly on countries in Central America and the Caribbean. They're obviously being recognized for not only their growth resilience, but also better fiscal policies and debt reduction. None of the bigger countries in Latin America are on positive outlook. That's something that you would have seen here as well. And the only country that's on negative outlook is Colombia, reflecting the deterioration that we've seen in Colombia's fiscal profile. So the big question really is, where do we see ratings going from here, given these uncertainties? And I think there we'll be looking at a couple of things. First, we'll be looking at what we call rating headroom. Clearly, ratings have been coming down in recent years. There's been a lot of red in the slide, which is when ratings were on negative outlook or then were eventually downgraded. A lot of downgrade activity during the pandemic and somewhat during the war on Ukraine. So we think there's headroom after these downgrades to absorb some of these deterioration in some of the credit metrics. And the second thing that we're clearly going to be focused on is how are countries actually managing their policies, how are they managing inflation, how are they managing their fiscal profiles, and whether or not we're going to see reforms going ahead, which will again influence the rating trajectory going forward. So that's where I would end, and thank you very much for your time and attention. Thank you.